Good afternoon, everyone. Morning for some, evening for others all over the world. Welcome to today's live trade session for TPO. Of course, today is Monday, 11/23, and yes, I have to look at the screen to be able to remember what day it is anymore. We are going to go ahead and get started today. Of course, triple play options is a wide variety of different approaches based on the weekly option spreads Monday, Wednesday, and Friday. And we basically divided into three categories: trades that you can take when the volatility is high, trades that you can take when the volatility is low, and trades that you can take when the volatility is kind of in between. And I know most traders would like an option strategy or spread that they can place on week in and week out and never change it, no matter what's going on in the market conditions and whatnot. But unfortunately, that's just not possible because you can't get the same price for these spreads when there's different volatility going on. And so that's the way we play it. And today, what we're going to be doing is we're going to be talking about two different approaches because there is an approach there are two approaches that are available based on the current volatility levels. So that kind of gives you a brief overview of what TPO is. And if you are new on the call, which is why I went over that, because we do have some new folks on the call today, I do want to welcome you. But I also want to warn you that I do not explain everything about these trades on this call, nor can I explain everything about the trades on a single call. There's just too much information. That's why these calls are done twice a week, and most subscriptions are for a year. It is very, very, very helpful to attend these calls. They're meant to build. The more you attend, the more you're going to understand. I also want to warn you that these trades are fantastic. We've had a really good streak over the last 3 or 4 months, and there's some very good trades. But you need to start small. You need to start small. If you've never done this, if you don't know what you're doing, start small. You need to make sure that you're not reckless with how you throw these together, and then you want to make sure that you follow the instructions. Great trades doesn't mean you can throw caution to the wind. There are risks. As always, this is trading, and you have to understand those risks. Otherwise, you're prone to mistakes. But the great thing is that you don't need to start big with this, because the compounding is such a powerful piece of the puzzle. It is the most powerful piece of the puzzle, as a matter of fact. So you can start small, and then as you experience success, you can grow your account by increasing your trade size. And if you can average just $100 a week on average over the course of 6 months, you're talking about growing a small account to as much as $30,000 in a very short period of time. If you can't average $100 a week, and most of you are not going to start by averaging $100 a week, you're going to feel your way around and to see how you want to trade these approaches. And you may only average $50 a week, and that's fine, because you're still going to grow your account very, very quickly. But the best part is that if you start small and you don't make money, in other words, for whatever reason you made a mistake, you just bad timing on when you started the trades, or whatever the case is, you don't lose big, right? So as you prove that you can do it, and as you prove that it is working for you in your account, then you earn the right to increase your trade size. And if you continue that streak, if you continue $100 a week on average, okay, you're not going to make $100 every week. We're talking about averages here. But if you can do that, you're talking about growing your account over $3 million in just 5 years. $50 a week grows it to over $1 million. And even if you only average $20 a week, and it would be very difficult, if you're doing things right, it's very difficult to not average $20 a week using this approach. You're still going to beat the best performing stock over the last 5 years, which was Netflix. So it pays to just simply try and be consistent and then apply the compounding. All right, so there's my intro. We're going to get into today a couple of things that I'm going to focus on today. Number one is lower risk trades, because I did get some requests to focus on lower risk trades for the purpose of compounding. Even though my favorite is it is a little bit higher risk, but you actually have a greater probability of success, and you have more profit potential. So you give some, you take from another, and it's just basically what you are able to deal with. If you're able to deal with a little bit larger risk and still be aggressive, then that's certainly available to you. If you want to absolutely limit the risks so that you don't get caught on a single trade, and by the way, if you get caught on a single trade, the probability of you getting caught in the same manner on the following trade is almost nil. Because of what has to happen. We'll discuss that a little bit. But so for lower risk, I went to the route of simplifying things for today's call. This is something that we have looked at again, or we've looked at least once in the past. I think it was like 2 or 3 weeks ago, where I introduced some other ways of this approach. And of course, what we've been focusing on is what's called crazy calendars. And crazy calendars is simply where we're leveraging calendar spreads. We are leveraging the profit zone of calendar spreads. And we're creating this trade structure that gives us a very, very high probability of realizing a profit on the trade. And so this is one of the trades that I actually took this on Friday during another live trade call session, different group, but this one is very much what we have been doing, only it's using a diagonal spread to pay for the calendars. And in this particular example, it was short 1 December 4th, 362, long on December 7th, 366, and then long for December 4th, 365 calendar. So this one is not this week. This week is a short week. This week's we could not put on this week's trades last Thursday. It was already too late to put on a trade for this week, so we had to start looking at next week already. And next week is a little bit different, so I do want to caution you before we get too far into this, and I'll bring that up here in a second. But you'll notice here that credit of 6 means if the market tanks, you can't lose money. You're going to make at least $6. If the market stays the same, you're probably going to make $20, $25, $30, $35, $40, somewhere around there if you hold on to the last minute. If the market begins to move up, the more time that passes, the more that we're going to see a profit. Matter of fact, this particular trade right now, you cannot get for a 6-cent credit. I believe it's actually trading at about a 20-cent debit right now. And so I'm making about $25 on that particular trade, on this particular trade. And I've only been in it for about a day and a half at this point. And there's still obviously a lot of time. That's what I mean by high probability, is that unless you get into this trade and immediately the market tanks, you're going to make $20, 20, $25. You're going to have an incredible high probability to make $20, $25 if that's all you wanted to do, and compound that. It would be very, 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 very consistent way of doing it. All right, now this one is here because it is a smaller risk trade. And the smaller risk trade is based on the fact that we have this diagonal spread, the short 362 and the long 366. Now I sold this diagonal spread for $1.10, and I did 4 calendars for, I think, around 26. 26 cents is what I got filled on, and that is what gives me the 6-cent credit. This diagonal spread is what I use to pay for the calendars. That's basically the whole gist of it. And it creates this profit zone. The market has to move up through the profit zone in order to, before it ever reaches the risk. And you'll notice the risk here, it is limited risk. Now, what is the total risk on this trade? If any of you know, based on doing the calculations on the strikes, right? We're at a credit of 6. There's total strike difference. You don't have to worry about the 365 calendars because that is included in the 6-cent credit. So really, the risk is 362. The difference between 362 and 366, plus or minus the debit or credit. And so in this case, the maximum risk on this trade is $394. Okay, and it's way up there. And I mean way up there, because in order to lose $394, these calendar spreads have to be worthless. Now the 4 calendar spreads have to be worthless, and those calendar spreads hold their money when they are in the money. And so it is something that is very, very, very low risk to actually realize the $396 maximum risk on this particular trade. The market has to skyrocket, and it has to stay up there before it ever has a profit while it's going through the profit zone. And if it does that, and I mean, we're talking the maximum risk, we're talking maybe 370, let's see, 365. So we're talking minimum 375, 376, 377. That's 20, basically 20 points away before you ever get to the threat of realizing the maximum risk on this trade. 20 points away. And if that happens, what is the likelihood that you're going to see another 20-point move when we're making all-time highs in this scenario? Now, if the market crashes, that's a whole nother story. If the market crashes, the first thing you want to do, listen to me very carefully. If the market crashes, the first thing you want to do is make sure you block out the time for this call. So obviously I'm talking about the current situation with the market being already basically sitting right under the all-time highs. There is a governor that is working with this to prevent it. There is a limitation on what it can do as far as how high the market can go. Now, I say that, and I'm also going to tell you that we're about to enter the most bullish period in stocks on a seasonal basis. Now, you might be able to just throw all of that out the window this year because of everything that's going on. But from going into Thanksgiving, it's bullish. And then the first week of December is technically and typically the most bullish short-term seasonal in stocks you will see. So we certainly could do that. And moreover, I'm going to start bringing these. Down. Moreover, I want you to take a look at what we've got going in the news events. And if you're familiar, what I do is I show these upcoming news events for the sake of understanding volatility and what is coming up in volatility. All right, so I go to Market Watch, their economic calendar, and so this coming week, it's really obviously there's nothing going on. November 26th is Thanksgiving. 27th, there's nothing scheduled. On Monday, you've got Chicago PMI and pending home sales index. That's nothing. It's not going to affect the market. So volatility is already starting to drop out of the calls this week, which we'll see here in a second. But next week, and by the way, this week's trades are all profitable. I've already exited like half of my trades this week because the market did drop down, and I was able to take a pretty decent profit on a lot of trades, averaging about $70. Nothing major, but I didn't exit everything in case the market does move up towards the end of the week. I have some pretty decent profit zones at 364, 365, 367 area, and we'll discuss that here in a second. But look at what comes next week. So Friday, December 4th, that's what we're looking at, December 4th, December 7th report. And we don't have anything on December 7th because they haven't listed it here. But on December 3rd, that's where it really starts to get going next week. On December 3rd, we have initial jobless claims, and we have continuing jobless claims, market services PMI. That's not really that big of a deal, but these two initial jobless claims are. But then Friday, we have non-farm payrolls, we have unemployment report, we have our average hourly earnings, trade deficit, and then factory orders, which that's not a huge deal, but all of these together will keep volatility high going right up into Friday. And then after these announcements are made, market does whatever it's going to do, we're going to start to see volatility drop really fast on Friday. But until then, we will have a pretty high volatility. And these are things that can move the market. So you've got the most bullish week of the year seasonally, and these are things that absolutely can move the market. Whether everything else that is going on, they're talking about threatening the shutdowns again. The political junk is still going on. However that affects it is a whole nother story. But I'm just giving you, I'm not making any predictions, by the way. I'm just telling you that we could see a pretty decent move to the upside, or we could see the markets crash. So you have to be prepared. But again, that is why I'm going to focus on the limited risk trades this week. And this is similar to one that you can take. By the way, you can, if you want, you can go out further in time if you want and put on these trades. But you have to understand that the more time you give the market to move, the lower the probability of success. So you have to compensate for that by going further out of the money. And that also gives the trade more time to move in the opposite direction so that you're only going to reap the minimum credit on the trade. So 2 weeks is about the max that I like going out with these trades, and there's nothing wrong with going out 2 weeks every week. And so Friday, go out 2 weeks. This coming Friday, go out another 2 weeks. This coming the Friday after that, go out another 2 weeks, and then you are still rolling the trades on a weekly basis. But that's about as far as I go. And then if you're getting into 2 trades, one this week and one next week, and the market moves up significantly, then you may not, you may be stuck and you may not be able to get into another trade the following week. But all of these things are just things that need to be considered as you're going into these trades. All right, so let's take a look at the current situation. And I'm going to bring this down again. And so I've got everything on one screen. So hopefully we can move through this pretty smoothly as we go through this. So the market's coming down just a little bit from where it was. This is the trade I have on, not this one, but let me change this real quick. And right there. So this is the trade I have on from a total credit of 6. And as you can see here, right now, it's basically at about a debit of 12. 12 to 15 cents is where, so it's making about $20 right now. And it's a 362, 366. I got in there for $1.10, got these for 26 cents. And those are down to 23, the 365s. And of course, I did 4 of them. That's so as many as will go into the credit. That's basically the best way to do it to create the profit zone. And so already this isn't even available. But what I'm going to do is I'm going to show you. So we're going to take a look at the following week just to cover that. And we'll go 1214 and 366. And then 12. Where's that? 1211 and 1214. All right. So you can see the following week, this is trading at $1.07, and these are trading at 26. So basically, where I got into last week's trades at, that's where it's at, and these are probably going to remain fairly similar throughout the week. The problem with this one is that it's too much time, and the market's too close, right? So on this one, I want you to look at the difference between the spread here, the diagonal spread, is making money, right? 1 week, if I get into this right now and the market stays the same, I'll probably be making 25 cents on this diagonal spread 1 week from today. Probably losing just a little bit on the calendars based on where it's at, 26 versus 24. So those are going to remain fairly stable. So the question is, what do I get for this diagonal spread? That's why I'm not going out to 1211, 1214 yet, is because it's just too much time and you don't get that much better of a price. So I would rather do this. I would rather go in here and do a 367. And that increases the overall risk. But you still have the credit. Okay, so almost at this point. If I can get 23 cents on the 365s, then and do the 362, 367 for $100, then I can pay for the options, still have a small credit. So if we're getting a little bit too close, and again, it's a little bit different because this week is a short week, and so that is actually affecting the following week's trades just a little bit on the prices. But I would rather do something like this than go out another week on this particular trade just to get another 25 cent credit. Okay, so with this you can do that, or if you wanted, you could drop it down to, my goodness, my mouse is, you could drop it down to a 361, 366. Again, you now have a $1.13 credit, and you can still do the 365s if you want, because that's still less than the 366. You're creating just a little bit of a dead zone there, not much, but you can definitely do 4 and you'll have a pretty decent credit. And as long as the market stays, I'd say below about 368-ish, we'll throw this on a graph here in a second, you should be able to have a very, very high probability of being able to pull out a profit on this trade. We're trading at about 356.50 right now. If the market goes to 361, we're gonna be taking an open position loss. And if we're to do that today or tomorrow or Wednesday, we're probably going to be taking open position loss on this trade. How do I know that? Well, we're going to take a look at the spreads, at the different spreads. So here are the calendar spreads. Okay, they expire 12/4, 12/7. Here's 354s. That's basically in the money a little bit, and we're talking about those being at 38 cents right now. In the money, and they're trading at 38 cents. They were trading at 33 on Friday, so those have gained about 5 cents being in the money. 355, same. We'll just scroll down here till we get to the 360. Let's say the 362s. Okay, 362s right now are about 6 points out of the money. Okay, 5.5 points out of the money. And they're only going for 31 cents, right? So we're looking at 365s. 365s are going for about 24 cents, right? So you're going to make about $7 a piece on these. That's a total of $28. If the market were to move up 3 points right now, we'd make about $28 on the 365 calendars. However, what would we be losing on the diagonal spread? And so I have here specifically the 4-point diagonal spread. So I have here the, let's see, we were talking about 362s. And so if the market moved up, that would be equivalent to the 359s right now. And you can see that those are going for about $1.25. So we can switch this to a 364, and that gives us the 5. So those are going for about, it looks like about $1.50. So I'd be losing, if the market went up 3 points right now immediately, I'd be losing about, or making about $25, $28 on the calendars, and losing about $50 on the diagonal spread. So it can move up too quickly to where you can't get out at a profit, and that would be certainly the case. However, if we were to look at the 1127s, let's look at the same thing on the 1127s, 1127, 1130s. So the 362s, which would be equivalent to the 365s if the market moved up 5 points a week from now, right? So on Monday, if the market is moving, has moved up 3 points and is trading 3 points higher a week from now, then the same spread would be about 41 cents on the calendars, right? This is how I project. This is how I go and I look, okay, will the trade be profitable a week from now if the market stays the same? Or if the market moves up, or if the market moves down, you can go through this entire process by comparing the trade you have on right now with the trade that expires this week. And you can do that on a weekly basis, and you'll get a really good idea. All right, so I've been making about $15 a piece on the calendars, so about $60 on the calendars. What about the diagonal spread? Well, the 362, 366 is what we have. So let's go down to the 359. And you have the 359, 363. If we get it for $1 credit, it's trading at a 54-cent credit. So I'd be making about $110 on this trade if the market moves up 3 points by this time next week. All right. We can move this out a little bit, and we'll see that that's at about a 66-cent credit, 69-cent credit. So we'd still be making money on that, just not as much, maybe about $35 on that one. So close to $100. If the market moves up on either of these trades, if the market moves up by about 3 points, that's about what you can expect on this particular trade. Okay, so if it does it too fast, you're not going to have an open position profit. But the good thing about this particular trade is if it moves up too fast, too quickly, it usually stagnates. And when that happens, look what you get. If the market stagnates, let's say it moves up too quickly, it moves up to 365. And that'd be basically almost 10 points from where it is right now, which it could do, and then it stagnates. Well, at that point, all it's got to do is stagnate there for a couple of days, and we probably will be able to look at see a potential profit. at that point. So you do not exit these. If the market is in the profit zone, but you don't have a profit, you do not exit these. And what I say with these trades, every time you get into a trade, you do not want to take a trade that you are not willing to hold on until the absolute end and realize the maximum risk. That's how you know you can make rational decisions and not decisions out of fear. Is when you take the trade and you say, you know what, if I lose $400 on this trade, it is not a big deal. And I know that if I lose $400 on this trade, I'm going to have an incredible opportunity for the next trade, right? And so that's the way you have to look at it. And on this particular, in this particular example, if you are scared of losing $400 on this trade, 362, 366, that'd be the strike difference. If you're scared of losing that $400, obviously you've got an issue with whether you should even take the trade or not. But most people on here, they understand. They completely understand that $400 is a very reasonable risk when you're talking about a 96% probability of success on the trade. So by holding on until expiration, or by getting out when it has a decent profit, which has a very, very high probability of actually showing. Okay, so that is what's available right now. So let's take a look again, so you can kind of put these together. Oops, not that one. So these are 12-4. These are the calendar spreads, and how far can we go out? So it looks like about the 362, 366s you can get for 80 cents. If I go to 367, I can bring in a little more than $1, maybe $1. And I may even put the order in at $1, and then pay for the calendars. Okay, so that's as far out as you can go. Bring in about $1 on the spread, and pay for 365 calendars. Now, if you wanted to, you could go 366 calendars and pay even less. That's going to give you the profit peak at 366. Or you can go 367 calendars and pay even less. You're talking about 18 cents at that point, 19 cents. You can go 5 calendars with that. So let's take a look at what that looks like on this. So I'm going to go ahead and duplicate that. And before we get to the end of the day, we are going to be talking about this trade right here. And I'm going to mention it just to show you. It's a pretty cool trade. But let's go with 367s on the here, and we'll do 5, and we can do this for about a credit of 6. Let's go. So I'll just refresh all this stuff, and we'll see where we're at. All right. So we can get in for about a credit of 6 or 7 on this particular trade, and I'll go ahead and refresh that. All right. So when we do it that way, I'm going to go out just a little bit. I'll get it right here in a second. There we go. Oh, you didn't see what I was doing. I was changing the perspective on the graph to go out a little bit further on the expiration. All right. So here is the new, and I can't get rid of those right now. We'll just leave them on for now. Here's the new graph. Here's the issue. There's a long way between the profit peak at 362 and the 367 calendars. And this actually affects you in two different ways. Number one, the further you go out with the calendars, the further away you put those calendars, the lower the probability is that you're going to make money, or as much money that you're losing in the diagonal spread the closer you get to these. Okay, so they're going to have a little bit harder time increasing in value, whereas you'll be in the middle of the loss zone for, let's say, for this diagonal right here, which is the red line, right? Because of volatility, and I'm going to drop the volatility in these so that we can see kind of a worst case scenario if we actually hold on until the absolute end. So I'll do that. All right. So you can see here, there's still a very, very, very large profit zone, long profit zone that is created, but you're, so right here, let's see, at 364, that's kind of in the middle of what I call the dead zone, which is the area between one profit peak and the next profit peak. And so the first profit peak is at 362, and then the next profit peak would be the calendars at 367. And so we'll go to 364, 365, and you'll see here that it says $156, $156 profit potential. That's at the end. And if that is off by, let's say the value of the longs are off by 10 cents. How many longs do I have on this trade? I have 6. So if the longs are off by 10 cents from this projection, then I may only make $100 on this trade at the end if it's in the middle. Moreover, it's going to be more difficult for the actual open position profit before the expiration to actually be in that level. So let's take a look at the 367s right now with the 1127.30s and 1130s, 367 calendars. Those are trading at 13 cents, right? So there's still value. The 362, we already know that 362, 367s are at 23 cents. So if the market goes nowhere, this trade's going to be making a lot of money, a decent amount of money, I should say. So you'll be making $75 on one and be losing literally only about $25 on the other. So you'll be making about $50 on the trade this time next week if the market goes nowhere. What if the market skyrockets? Goes into, let's say it's trading right under the where the calendar spreads are. Okay, and right now the market is trading at, where's the market trading at right now? Let's see if I can find that on one of my other screens. Market's trading at 356.63. So let's go with the 354s. Let's take a look at the 354 calendars. Those calendars are in the money and they're trading at 70 cents. All right, so this would be equivalent to 367 calendars if the market is trading at 365. Okay, so we're these are in the money. We don't want to go in the money. We want to go out of the money. So 357s. Let's go 357s. Okay, so those are slightly out of the money, and those are trading at 72 cents. If you can get them for 18 cents, obviously that is a pretty decent profit, 54 a piece. And if you do 5 of those, you're talking about a $270 profit. Okay, but that also means that our spread, which would be a 352, 357, So we'll go down here to the 352s. We'll change that to 357. 1 second. And if we were to get that at $1 credit and it goes into the money 1 week from now, it looks like it'd be losing about $177. So actually, it looks pretty good. Better than I thought it was going to look. It's basically an open position profit right now of $100. If the market moves up to 365-ish, 366, somewhere around there, by Monday of next week, then the trade that we're looking at right now with the further away expiration, or excuse me, a further away calendar. I feel like Joe Biden. Sorry. 367s. So 360, let's go 361, 366s. Let's go 362s because those are going for about $1.16. So we can go 362 and 367. And you can put this order in if you want, if that's how you want to do it. So you can literally go 5 calendars for 18 cents and do this credit at $1, and we have a really, really, really high probability of making money on this trade come next Monday. So that's the trade I'm going to do for today for you guys. So we'll go order 1, and we're going to do a credit of $1. And then we're going to do, and by the way, you don't have to do this separately. So I'm going to do a debit of, let's see, I'm going to do 19 cents. Okay, and I'm going to do 5 of them. Okay. So I'm going to save this, and then I will turn it on. This has a little bit more risk because it is 5-point strike difference, but we're going to wait for the dollar, basically the dollar credit to get filled on that. Okay. Now, if I wanted to do this all in one order, which I have done, and let me show you something here. If I can find it. Nope. So 350. Yeah, these are all one orders. Little bit different, but all one order nonetheless. So these are with 4. So 357s, 362s, and then the calendar spreads are actually a little bit further away. Let's make these 362s. So they are exactly where the long is. So the calendar is exactly where the long is. And I'll reset the spreads and generate the spreads, and we're going to get a bunch of different. So this is all one order. And you can see here, here's the 350, 355, and then the 355 put it. So if the market moves up, immediately 10 points, so that actually 12 points, so that we're in the money, we're going to be losing about $172 on this trade. Okay. Obviously, if that happens and it's a week from now, then we're going to be making money on the trade. Okay. So let's just go through this here real quick. And we will take a look at how far can you go and still bring in a credit with just 4. And you can go 365, 370, and 370s and bring in a credit of 8. That goes way out of the money. The market can go all the way to 375-ish before, maybe 372, 373 for a break even. Obviously, if the market moves up to 365, you're going to be still 5 points below the calendars, so you're not going to be losing all of the calendar, which are really cheap, by the way. 370 calendars are going for about 13 cents. So it's definitely something that you can do if you want to go really, really high probability. Bring in just $10. Try and get a $10 strike or $10 credit. You can do that. But this is only 4 calendars. With the order that we have working right now, there are 5 calendars. 5 calendars. Okay, so I put in an extra calendar there to create a bigger profit zone on the trade. Okay. All right. Let's see here. Where was I? Is it this one? This is the one. So on the 363, 368, you can go for a $20 credit on that one. And the market can go up. We're going to drop these to 4. I'll show you that there will be a difference in the profit potential on this trade. You can see, oops, that's not it. So we'll come back down. All right. So with 4, you have a much smaller profit zone. The dead zone is dragging a little bit more. The projected profit at 364 is actually going to be $1.16. With the situation that I just went over and I said, oh, look, we'd actually have about $100 profit. We can drop one of the calendar spread profits, which would be about $50. And so instead of a $100 profit, you might have about a $50 profit if we move up to 365, 366 next week. But it's still a $50 profit. It's nothing to sneeze at. And you have a very, very, very high probability of success on the trade. With this one, it's actually a 25-cent credit. So that's where you're gaining. Is if the market tanks, you're going to still make about 20. You're going to make $25. And if the market doesn't tank, you're not going to make as much as the market goes through the profit zone or at the profit peak, for that matter. So it's give a little bit of one, take a little bit of the other. All right, so that I think is probably the best simple way to limit the risk on the trade and still create the same type of scenario. And again, you can lower the distance between the strikes on these, the short and the long. You just won't bring in as much credit, which means that you won't be able to bring in the same number of calendars as you can. So let me do this. And so this shows 362, 366s, and then 367 calendars. Shows for about a credit of 7. Again, I have 365 calendars, not 360 on this particular trade. And so on this one, it's kind of a similar deal, but you lower your risk. Look at 372, the projected risk is like $250. So you lower your risk. You still have a decent profit projection at what is that, 364, which is pretty much the bottom of the dead zone between those two strikes. So you can do it either way. You just have to decide, if you're trading a really small account, this is the route I would go. I would go a smaller, 362, 366, with maybe 367s on the calendars. Okay. Just understand you're not going to make a lot of money if the market moves down. You're not going to make a ton of money at 362. This says $157. I doubt it. You're probably going to make $100. at that point, because the calendars are not going to be, and that's if you hold on until absolute end of expiration. Okay. All right. So that should make something very simple for you guys to focus on, to look at and explore, take a trade. This is something that basically everybody can do. You can put it in as one order, no problem. All right, let's talk a little bit about one other thing, and I can't believe how little time we have left already, but option insanity is a viable approach right now. Option insanity being the opposite, where we sell the Mondays and buy the Fridays. And there's one major caveat that is the problem with that, and that is that you have to have margin hedges. Because if you sell Monday and buy Fridays, the brokers are going to charge you full margin for those trades, and you just have to have a lot of money to put on them. But you want to talk about ridiculously high probability trades. I mean, ridiculously high probability trades. You can put on some ridiculously high probability trades with this thing. But the risk is also higher. And so, for example, here's kind of an extreme, and I do have this exact position on right now. It is an extreme, but it is a very, very, very high probability trade, and it's basically where I'm buying an in the money, or not in the money. I'm buying a lower strike Friday option. This is a 362, and I'm selling way out of the money, 5 of them, Monday options. And for the total thing, I'm bringing in a credit of 35 cents. So this thing has a huge profit bubble, close to about. And this is without dropping volatility very much. So if volatility drops even further, the profit bubble increases. So it's exactly the opposite of when you're selling Friday, buying Monday. You just have to put the right combinations together in order to get these effects. And so this is an example of one where there's a huge profit bubble. The market has to go way out of the money. And if it doesn't, I'm going to make at least $35. You can't be as efficient with this one, but when it moves up here, you're talking about quite a bit of money. $500 is not out of the question on this trade. And we're talking the market going 368, 369, 370. In fact, you don't even get to a break even until you're about 373, and that's maybe because the volatility will drop, and so you're probably still going to be making some money, even at 373. So think about this: the market has to go up to 373 by next Friday, without you being able to take a profit of it going through this bubble. Okay. And I realize this is not going to be something that most traders are going to be able to do, but it's something that I did want to show. So I got that thing for a credit of 35 cents. Look where this week's is, or this week's trades are, I should say, based on the same thing, 362. Oh, that didn't do it. 363 70s. So I'm 362 372s is where I'm at, and I'm at a credit of 35 cents. Well, this one, the 360 370s are at 50, and this is still out of the money, is at a 53-cent debit now. And so that's basically $85, $90. Okay, you go in the money a little bit more, 359, 369, a debit of 81, and then a debit of 105, and then a debit of 131, and we'll just keep going until it turns around. So we're up to 355. So they're basically at the money. So the shorts are at the money. Debit of 168. We're not even in the profit bubble yet of this trade. 168, then 151. So as it's going through the profit bubble, okay, remember I got in these at a credit of 35 cents. And so a debit of 35 cents, 45 cents, whatever this is, it means I'm making 45 cents plus 35 cents. Okay, so 80 cents on that trade. I'm making $80 if the market moves to where my 362s are in the money by about 5 to 7 points a week from now. Here is where it changes, the 350s and 360s, and it's a fast change. You go from a debit of 50 to a credit of 52 cents. Okay, and then you go into a credit of 181. So this would mean that we are about 359, so we're trading at about 370 by this time next week. Then I'm losing $150. Okay, and I can get out if I want, right, at that point. So then it goes on a little bit further. That's the risk on this trade, is if we move up really fast, really high, this would be representing a move to 373-ish based on the trade that I just showed you. All right, so that's one example, and I would have to have margin hedges for all 5 shorts. Okay, so that's one example. That's a bigger risk trade, but very, very, very high probability on that trade. So let me get to another example. And we're gonna scroll right on up here to, this is a standard one that I actually use this one for a hedge, a bearish hedge. So let's see here. None of these, there we go. Here's one. Well, let me go to a different one, actually. All right, so here's one where you see that if the market moves up enough, it makes a little bit of money. If the market moves down, it makes a little bit more money. And then there's this dead zone here, and this dead zone is actually very, very good. But one of the ways that you let's just open this up real quick, and I'll show you exactly what this is on a different level. So if volatility drops, which it will on Friday of next week, it won't drop as much as it normally does, but it will next Friday. You're talking about max risk of $100 with it not dropping, a little more than $100 with it not dropping. It's probably going to drop, which means that this is probably going to be a break-even area. And so you actually have this little bitty slither of area where you're going to lose money. And then if the market moves up, you can make actually about $22. Okay. Well, how does this make $22? Well, the strike difference between this spread is actually $250. And so if I can create a credit that's bigger than my strike difference, then I create a profit potential to the upside. All right. So this is actually selling the 354, selling 2 354s and then buying a 353 and a 357.50. I don't know if you can see that, but I'll show you something here in a second with regard to that to a similar open spread. So if the strike difference is 2.5, and I can get credit for more than 2.5, then I can make money both to the upside and to the downside. But really, the money is to the downside. And so I actually use this as a hedge for some long stock positions. So if the market crashes, I know I'm going to make a decent amount of money. Only I have a little bit different of a trade going on. And I'm actually losing a little bit of money on this trade, which is fine for now. So I'll pull this down. This is a long 349, long 351, and short 2 348s. And I got filled at a credit of 436. This was Friday right before the close. Credit of 436. The strike difference between all of these, if you add it up, right? If you go 349 to 348, that's -1. And then 351 to 348, that's -3. And And so basically I have a -4 and I have a credit of 436, which means that if the market moves up high enough, I can make $36. And if the market moves down, then I'm going to make $400, possibly $436. That's the credit, but it has to move down below 348. And it has to move down significantly below 348 for me to make the entire $436. Probability of me actually closing out a trade at a loss here is very, very small, because on Friday, and I wish I would have saved this, but I didn't. But on Friday, if I would have been in this exact trade at the worst possible place on Friday, the spread was trading at about a 456 credit, which means I would have lost $20 on the trade. So that is why I put these trades on. Mainly, this type of trade is what I put on as a hedge. And let me pull something up here. I thought I had it on this graph, but apparently, oh, here it is, only reverse. So we'll go sell and buy and buy. And I'm actually filled at 436. So we'll go and that's good enough. All right, so that is graph 3. There is the graph. This is actually 360, 362, 359. I don't think you can get that. I don't think you can get a 435 credit for those strikes. So I should probably change those strikes. Let's do this. What's this one? Nope, nope, and nope. Okay. I'm actually in where this particular strike right here, this is based on 362, right? So my long is actually 351. So this whole thing could move down to where this little very small area where I lose money is actually at 351. Okay. And so I'm doing it based on a move down. I'm placing this hedge or this trade on as a hedge. And it's just a good low risk hedge because the market has to move down to 351 to get into this little loss zone here, and I have to hold on to it to the last second in order for that to happen. If the market moves up, let's see, let's say it's 357, I'm probably going to make $10, $20 on the trade. Right, and no matter what, if the market moves way, way, way high, I'm going to make money on the trade. So again, those are just a couple of examples of some option insanity trades. You can do a, let's see, you can do a 1-to-1 MDOP trade and create this very strange, because they're trading at, the MDOP trades are actually trading at debits right now. And so you can do a 1-to-1 and trade it at a credit. And if you're not familiar with the MDOP trades, then it's something that, that's not right. Nope, that's the one. So that's not the one I was wanting to show you. So I'll save that for next time, because you can place these on like right before. A lot of these times you can place these on right before the market expires and get the same overall cost basis. Let me pull this back down. So right now this is 1127, 1127, 1130. And I can do the same one for next week, basically, and still get a similar price. Okay. All right, one last thing. We're going to switch gears real quick. Here's my 365, 367s. All right, this is the one that I like to do the most, and that is just simply sell a call, buy a margin hedge, and then put on some calendars. I got out of some of these. I did a bunch of these. I got out of some of them for $70 profit a piece on Friday. This is actually showing two of these, which it shouldn't. They're going to change this, but it's right now it's trading at about a $75 profit as well. So again, market's trading. Looks like we're moving up. Looks like we're moving up significantly from just 30 minutes ago. So that is actually moving into my profit zone. All right, I know I covered a lot today. Let's see if we got Q&As. IB seems a little tricky at placing whole orders at once. 1144 to calendars at the same strike long, essentially a spread of 145, which IB won't allow to place. Yeah, that is a pain in the rear. TradeR lets you place those. I want to take a look at option insanity. It looks kind of complex. Is there a seminar full access? Yes. So one, yes, if you have full access, you have access to the option insanity lessons that we've done. So contact support. If you don't have access to those in the resources, contact support and they'll get you access to those. Okay. All right. Let's see, any other questions? Carl, which new trade partner? Are you talking about TD Ameritrade? It's out. If you want a copy of the TD Ameritrade contact support, they'll get you a copy of the TD Ameritrade. And I go to YouTube, you'll find videos on Trade Partner. All right, let's see here. All right, how can I get the OI reports that are referenced in the calls? The reports that were done for option insanity, I contact support and just say, hey, I want access to the option insanity reports. Oh, the one I'm using, the one where we use the spread patterns, it's going to be out this week, I think. It's not perfect, but you guys will just have to understand that they're still going to be doing some stuff on those. On option insanity trades, you have to wait until the day of exit to exit those at a profit. No. So the trade that I have on right now, I don't know why that's not showing up in my spread, but the 5-1 trade that I have on right now is actually showing a profit, and it was placed on Friday. Where is that? So this one is actually showing a profit right now. I have something to play with dice. Yep. All right. Looks like I got all the questions. So there will not be a call Thursday if something bizarre happens in the markets. If we skyrocket, if we tank, then I will schedule a call for Friday. If nothing is going on any different than what we're seeing right now, up or down 5-7 points, doesn't matter. I'm not going to do a call. So I'll let the market dictate that. And obviously, if I decide to do a call, you'll get notice of that once it is posted. And I'll know Wednesday. So if you don't see a call that's scheduled by Wednesday's close, it's not going to be one. Okay. All right. I think that's it. Everyone have a wonderful week, and I will see you next month. Monday, barring something odd happening in the markets before then. Everyone have a great day.